One of the folks making that kind of a prediction is Jay Hatfield, founder, CEO, and portfolio manager at ICAP, and he joins us now. Jay, it's good to see you. It's been a while. You're looking for a potential sharp move higher in oil, perhaps to as high as $150. How likely do you think that is to happen?
Well, the key variable to watch, thanks for having me on, by the way, Julie, again, it's great to be on. The key variable to watch really is China. So keep in mind the basic numbers. So Russia exports 6 million barrels per day of oil. China consumes 10 million. So, and oil is fungible. So if China buys from Russia, they cannot buy from the Middle East. So we don't really know how that's going to sort out. Is China going to take all those barrels? But where you get to $150 a barrel is if half of those exports don't get into the international market, then that's roughly the break-even price that would equal supply and demand. So that's what we need to focus. But keep in mind, the reason we've had the spike already is there's been a global cancellation of Russia, so there's a lot of difficulty of getting barrels to market.
Jay, we've also heard some calls by a few folks in the street looking for potential $200 a barrel. Are those calls just ridiculous in your view?
Well, 150 is half of the Russian oil getting to market, so that would be through China. So if China joined the global cancellation, you could get to 200. Keep in mind, though, that time is your friend. There will be conservation, and there will be new drilling. There's substantial increases in drilling going on as we speak, particularly from private companies. There's not zero response, it's just there's a lag. So time is our friend. You'll get better supply and, of course, conservation the higher the price goes.
Jay, one of the things that you guys do is run an ETF that has MLPs in it. A lot of those are midstream companies, right? Pipeline companies. How are they being affected by what's going on with prices?
Some of the companies that are further upstream, called gathering and processing companies, they have some commodity exposure. But one of the dynamics that investors don't appreciate is when the Biden administration canceled the Keystone Pipeline, they essentially canceled all pipelines because you really need the federal government to support pipelines because there's tremendous local opposition. And by the way, there's local opposition to wind power as well. So without the federal support, there will be no pipelines, which sounds terrible, but if you own all the pipelines, it's actually a monopoly. So it's a good long-term dynamic for those companies, but they don't benefit as much from the commodity price spike. But the flip side is that they also have lower volatility. So it's a conservative way to play the inflation and oil shortage with a lot of yield, but you don't get the direct upside if we go to $200 a barrel.
Gotcha. And you mentioned inflation, so I kind of want to pivot a little bit in that direction after the CPI numbers this morning, because you also have an interesting outlook on the Federal Reserve and how perhaps the market is getting it wrong here. I mean, we're hearing a lot of predictions for 7 rate hikes this year. What do you think? How do you think everything's going to play out with inflation seeming pretty persistent?
Well, we've been super bearish about inflation last year because we watch energy, of course, and housing as the two key sectors. We think that inflation will attenuate, from this high single digits down to start to decelerate because of the increase in mortgage rates. And then energy will hit terminal velocity, whether it's at probably 125, 150. So then you start to get decline. So we're bullish about that. But also in terms of the Fed, what we think people haven't focused on is 5 out of the 7 permanent voting members, the FOMC, will be appointees of Democrats or actually Biden directly now. So they tend to be more dovish. So we don't think the Fed wants a recession. So we think they'll stop at the neutral rate, whether that's 5 or 6. And we're playing the Fed meeting next week as a positive inflection because even if we're wrong and it's more hawkish, at least it'll create certainty because you get the dot plot. This is the end of the quarter. So at the end of every quarter, you get the dot plot.
But Jay, even with potentially 5 to 6 rate hikes this year, and given where we are with energy costs in the country, are we still staring down the barrel of potential recession this year in the U.S.?
We don't think so. There's a dynamic that nobody really focuses on, which is the U.S. has become by far the most competitive manufacturing country in the world, keeping in mind that our natural gas prices are about 10%, which is hard to fathom, but in other words, they're 1,000% higher in Europe. So that means all materials, also obviously, so for instance, fertilizer, chemicals, and then just regular manufacturing, because natural gas translates into electricity prices as well. So we think that's a big tailwind for the U.S. So we're pretty bullish that not that we'll boom, but that we'll have 2 to 3% growth. And those rate increases are not really that significant. Short-term rate increases don't really affect economic activity that much. Long-term rates do, but not short-term.
Jay, I just want to make sure I understand what you're saying properly. So the increase in prices, you say, because we are producers of that stuff, will benefit the U.S. economy. Am I getting that right?
Yes. So because most people can't see it on their screens, but we watch it because we have those data sources. So it's almost unfathomable, but natural gas prices have exploded in Europe to just levels. So the equivalent of $400 a barrel of oil, an energy equivalent. So whereas in the U.S., natural gas is way cheaper than oil, it's way more expensive in Europe. And the other nuance that's not well understood is natural gas prices drive electricity prices because that's the only real peaking fuel. So we had on the total energy side, not just natural gas, we have this tremendous advantage. And that's why you've seen fertilizer companies based in the U.S. explode in price. You'll probably see good earnings out of chemical companies because they have cheap U.S. gas. So that's a big tailwind for the economy that nobody's really focused on.